What are the different types of corporate tax? Have you ever wondered how corporate taxes work and why they matter? Understanding the different types of corporate taxes can help us grasp their role in promoting social justice and addressing economic inequality. Corporate taxes are imposed on the income or capital of corporations, and they can differ widely from one country to another. Let's break it down. The most common type of corporate tax is the corporate income tax. This tax applies to a corporation's profits, which are calculated as total revenue minus expenses. For example, in the United States, the federal corporate tax rate is 21%. This tax is essential because it contributes to government revenue, which can be used for public services. Corporations can also be categorized based on their tax treatment. In the United States, there are C corporations that pay corporate income tax, and then there are pass-through entities like S corporations, partnerships, and limited liability companies. In these cases, the income is passed through to the owners and taxed at their individual rates. Now, let's look at specific types of corporate taxes. The statutory corporate tax rate is the official rate set by the government. However, this does not always reflect what corporations actually pay due to deductions and exemptions. For instance, while the statutory rate in the United States is 21%, the effective rate can be lower because of various tax incentives. The effective corporate tax rate is what corporations actually pay after accounting for deductions and exemptions. This rate can spark debates about tax fairness, as it often differs from the statutory rate. Another type of tax is the withholding tax. This tax applies to income earned by foreign entities from sources within a country, typically on dividends, interest, and royalties. There is also the value-added tax, which, while not a direct corporate tax, affects businesses by increasing the cost of goods and services. This tax impacts businesses indirectly, as it can lead to higher prices for consumers. From a socialist viewpoint, corporate taxes are seen as a means to redistribute wealth and reduce economic inequality. Higher corporate tax rates can fund public services and social programs, which align with socialist principles. However, the effectiveness of these taxes can be debated, as corporations may pass on tax costs to consumers or employees. Socialist policies often advocate for progressive taxation, where higher income earners, including corporations, are taxed at higher rates. This approach aims to ensure that corporations contribute fairly to the public purse, promoting economic justice and equality. Understanding the different types of corporate taxes helps us see their role in the broader context of social justice and economic equality. By examining how these taxes function, we can better appreciate their impact on society and the economy.